The Fed does what the Fed said it would do, but Fed certainty continues to create uncertainty for the stock market. Hello again, and thanks for joining us for this week's Fastest 4 Minutes in Finance. The Federal Reserve announced this week it would raise its short-term borrowing rate by another 75 basis points, or 0.75%. This brings the rate into a range of 3 to 3.25%, the highest level since 2008. The move was highly expected. There was even some opinion the rate hike would be even more aggressive, given the hotter than expected inflation data released earlier this month. But the markets still responded negatively to the news. Major indexes settled more than 1% in the red on the day of the announcement. The reason? Well, markets are just plain nervous about what's next. We may enter a recession, and if we do, it might be severe. It might not be. Optimism had taken hold after inflation appeared to be past its peak in July. We told you here on the Fastest 4 back then that investors had begun to expect rate cuts in 2023. While Jerome Powell nixed that expectation when he announced later that month in Jackson Hole, Wyoming, that the Fed would raise rates until the job was done. That sent markets reeling. I like how Jamie Dimon, the CEO for J.P. Morgan, puts it. He calls the economy, quote, a classic tale of two cities. On one hand, we are still seeing strong consumer spending and a strong labor market. But on the other hand, we still have persistent high inflation and policymaker-driven high interest rates. Dimon says, quote, there are headwinds and tailwinds, making it challenging to predict the future. He went on to say, even the best and brightest economists are split as to whether these could evolve into a major economic storm or something much less severe. The Fed moves are working to cool the economy in some sectors. Take the housing market. Sales of existing homes declined for the seventh straight month in August, down nearly 20% from August of 2021. This is mostly a result of higher mortgage rates. Rates have nearly doubled in the last year and topped 6% last week for the first time since 2008. Although data shows inventory is still low, homeowners are also showing reluctance to list their homes as the rapid rise in sales prices are slowing down. The median listing price in August was up 7.7% year over year, but down significantly from the peak in June. So there's still hope for this soft landing, which would allow investors to drive markets higher. Unfortunately, it could still be months before we know the answer to our cloudy economic forecast. And that brings us to our bottom line. If the best and brightest don't know what will happen in the next few months, how can we? This is not the time to bail out on your equity investments after enduring a beating in 2022. This is the time to stick to your long-term plan. If you don't have a long-term plan, it's time to get one. It is the best way to ride out an economic